Your crypto portfolio is bleeding. And the worst part? You have absolutely no idea why. You check the charts, you check the news, you tell yourself it's just a dip. You tell yourself to be patient. You've been patient. And yet, your portfolio is down 30%, 40%, maybe more. And somehow everyone around you seems to be talking about crypto like it's the greatest opportunity of their lifetime, while you're sitting there watching your account drain. This is not a bad luck story. This is not just the market being unpredictable. This is a pattern, and today we are going to break it down completely. Because here's what nobody tells you when you first get into crypto. The market doesn't just punish bad decisions. It punishes good people who don't understand what they're actually doing. And most of the time, the bleeding in your portfolio isn't caused by one big mistake. It's caused by 5 or 6 small, invisible ones that compound over time until the damage is done, and you're left wondering where it all went. My name doesn't matter. What matters is this. If you've ever refreshed your portfolio and felt your stomach drop, if you've ever panic sold at the bottom and bought back in near the top, if you've ever bought a coin that a YouTuber, a Twitter account, or a friend told you was going to 10x and watched it go to 0 instead, then this video is for you. Stay with me, because by the end of this, you'll understand exactly what's killing your portfolio, why it keeps happening, and what you can actually do to stop it. Let's get into it.
Reason number 1, you are buying narratives, not assets. This is the biggest and most invisible trap in all of crypto, and almost everyone falls into it, especially in bull markets. Here's how it works. You hear a story. Maybe it's a new blockchain that processes 1 million transactions per second. Maybe it's a DeFi protocol that pays 40% annual yield. Maybe it's a layer 2 solution that's going to make Ethereum obsolete. Maybe it's a meme coin that's already up 500% and people are saying it's just getting started. The narrative sounds incredible. The white paper looks technical and serious. The team seems legit. The community is exploding. And you feel that pull, that fear of missing out, that electric feeling that this is the one. So you buy in. And then 2 months later, the narrative dies. The hype moves on to something else. The token is down 70%. The project is still technically alive, posting updates on Twitter, but nobody cares anymore. The story changed, and your money went with it. Here's the hard truth. In crypto, narratives move faster than fundamentals. A coin can go up 500% on pure story, and then collapse 90% when that story stops being interesting. And if you're buying based on the excitement of the narrative rather than the underlying value, the actual utility, the actual adoption, the actual on-chain activity, then you are not investing. You are gambling on attention. Bitcoin has survived multiple narrative cycles, not because the story changed, but because the fundamentals didn't. Fixed supply, decentralized security, a decade of unbroken uptime. No CEO, no marketing team, just math and code. When you look at your portfolio, ask yourself, do I own assets or do I own stories? Because stories expire. Assets, real ones, don't. Before you buy anything, ask, what is the real utility here? Who is actually using this protocol today? Not theoretically, but today. What does the on-chain data show? How much genuine developer activity is there? If you can't answer those questions with specifics, you are holding a narrative, and narratives bleed. Reason number 2, you are trying to time the market and losing every single time. Let's be honest with each other here. You've done this. I know you've done this because almost everyone in crypto has done this. You watch a coin go up for 3 weeks straight. You tell yourself you'll buy the dip. The dip comes. You hesitate because what if it goes lower? It keeps going lower. Now you're nervous. You wait, and then suddenly it shoots back up and passes your original entry point, and now you're angry. You buy in at the top because you don't want to miss it again. And then it corrects again, and now you're underwater. That cycle, that exhausting, confidence-destroying cycle, has nothing to do with your intelligence. It has everything to do with a psychological trap called market timing bias. Here's what the data actually shows. Studies across traditional markets and crypto markets consistently show the same thing. Missing just the 10 best trading days in a year dramatically reduces your total returns. In Bitcoin alone, if you missed the 15 best performing days between 2011 and 2023, your overall gains would have been a fraction of what a simple buy and hold investor would have made. The problem is this: the best days and the worst days in crypto are clustered together. They happen right next to each other. So when you try to dodge the bad days by sitting in cash, you almost always miss the recovery. Ethereum went from under $100 to over $4,000 in roughly 4 years. But during that same period, it also dropped 60%, 70%, even 80% multiple times. If you were timing those dips, you were likely selling before the recoveries, because the dips always feel like they're going to keep going. Dollar cost averaging, buying a fixed amount on a regular schedule regardless of price, is not exciting. It doesn't make for a great Twitter post. Nobody's going to make a YouTube video called "I dollar cost averaged Bitcoin every week for 3 years and nothing dramatic happened." But that quiet, boring, consistent strategy has beaten almost every timing approach over every major crypto cycle we've seen. Stop trying to be clever with the timing. The market is smarter than your intuition, your chart patterns, and the influencer's prediction model combined.
Reason number 3. Your portfolio is not diversified. It's just risky in multiple directions. People hear the word diversification and they think, I own 10 different coins. I'm diversified. No, you are not. If you own Bitcoin, Ethereum, Solana, Avalanche, Cardano, Polkadot, Chainlink, and 5 DeFi tokens, and the market drops 30% across the board, everything in your portfolio will bleed simultaneously. Because in crypto, correlation is extremely high during market downturns. When fear hits, traders sell everything. They don't stop and say, well, this one has strong fundamentals, I'll keep this one. They just sell. Real diversification in crypto is not about owning more coins. It's about understanding the different risk profiles within the market. There's a massive difference between Bitcoin, which is digital sound money with a decade of network security, and a newly launched governance token for a DeFi protocol that has $200 million in total value locked and a team of 12 people. Both are crypto, but they are not the same risk category, not even close. Actual portfolio strategy looks something like this: a core allocation in the highest conviction, highest liquidity assets, Bitcoin and Ethereum, that can withstand multiple bear markets and still recover. A secondary allocation in established Layer 1 and Layer 2 ecosystems that have real developer activity and growing ecosystems. And only a small, aggressive allocation in higher risk bets, like early-stage protocols, new chains, or sector plays like AI tokens, real-world assets, or gaming tokens. And here's the part most people forget entirely. Stablecoins have a role in a crypto portfolio. Holding a portion in USDC or USDT isn't giving up on crypto. It's giving yourself the ability to buy at the bottom when everyone else is forced to sell. The goal isn't to have exposure to everything. The goal is to have strategic exposure to the right things in the right proportions with enough stability to survive the inevitable volatility. If your portfolio is 10 small cap altcoins and nothing else, you don't have a diversified portfolio. You have a high variance lottery ticket collection. And some of those tickets will win, but most of them will expire worthless. And the ones that lose will lose far more than the ones that win ever made you. Reason number 4. You are reacting to price, not responding to value. This is subtle, but once you understand it, you will never look at your portfolio the same way again. There is a version of you that checks the price of a coin and uses that price as information about whether the coin is good or bad. Price is up 30% today. Must be a good project. Price is down 40% this week. Must be failing. And you make decisions, buying and selling, based entirely on that price movement. That is reacting to price. Here's what responding to value looks like instead. You have a thesis. You believe that Ethereum's transition to proof of stake, combined with EIP 1559, creates a deflationary dynamic that makes ETH increasingly scarce as network usage grows. That thesis doesn't change when ETH drops 20% in a week. The fundamentals,
the daily transaction volume, the number of active validators, the amount of ETH being burned, the total value locked in DeFi protocols built on Ethereum, those fundamentals are either improving, staying stable, or deteriorating. And that is what should drive your decision, not the price. When price drops and fundamentals are unchanged, that is not a signal to sell. That is historically a signal to consider buying more. When price pumps and fundamentals have not improved, when the only explanation for the rise is hype, social media momentum, or a single viral tweet, that is actually a signal to be cautious. The entire reason retail investors consistently lose in crypto is that they buy high when the excitement is loudest and sell low when the fear is deepest. Smart money does the opposite. Not because smart money is braver, but because smart money is looking at different information. Stop watching price. Start watching metrics. Look at active addresses. Look at transaction volume. Look at developer commits on GitHub. Look at protocol revenue. Look at network fees. These numbers tell you something real. Price, in the short term, tells you almost nothing except how excited or terrified the crowd is right now. Build a thesis for every position you hold. Write it down. And when the price moves dramatically, ask not, should I panic, but has my thesis changed? If the answer is no, hold. If the answer is yes, then you have a real reason to reassess.
Reason number 5, you don't have a plan for the downside, and you never did. This is the one that hurts to say, but it needs to be said. Most people enter crypto positions with a very clear idea of what success looks like. The coin goes to $2 or $5, or it 10x's and I take some profit. That's the dream, that's the plan. But here is what almost nobody has when they enter a position: a plan for what happens when things go wrong. What happens if this coin drops 50%? Do you buy more? Do you hold? Do you cut your losses? What is the maximum loss you are willing to accept before you exit? What fundamental development would change your thesis entirely and force you to sell regardless of current price? If you cannot answer those questions before you buy, if you have no written, thought-through plan for the downside, then you are not investing. You are hoping. And hope is not a strategy. The people who survive and thrive across multiple crypto cycles are not the ones who got lucky with one trade. They are the ones who managed their risk so carefully that no single position, no single crash, no single catastrophic event could destroy everything they had built. We saw this play out in real time in 2022. FTX collapsed, Luna collapsed, Celsius collapsed, Three Arrows Capital collapsed. Billions of dollars vanished in a matter of weeks. And yes, some people were simply victims of fraud, but many others had everything in systems that were clearly high risk, offered yields that made no mathematical sense, and had no exit plan when red flags appeared. Risk management is not a defensive strategy. It is what separates serious investors from people who keep starting over every cycle. Your rules could be simple. No single position is more than 10% of your total portfolio. No position in a protocol that has not been audited by at least 2 independent security firms. A hard stop-loss rule that forces you to sell if something drops more than a percentage you define in advance. A rule that you never invest money you cannot afford to lose entirely. Simple rules, written down, followed regardless of how you feel in the moment. Because in the heat of a crash, you will not feel rational. Nobody does. The only thing that will save you is the plan you made when you were calm.
Reason number 6, you are taking advice from people who are paid to give it. This one is uncomfortable, but it's probably the most important thing in this entire video. The crypto content ecosystem is massive. There are thousands of YouTube channels, Twitter accounts, Telegram groups, Discord servers, and newsletter writers all talking about which coins are going to moon next. And a significant portion of them, not all, but a significant portion of them, have financial incentives that are completely undisclosed or buried in fine print that nobody reads. Here's how it works. A project pays an influencer or a content creator to mention their token. Sometimes it's a formal paid promotion. Sometimes it's a bag they've already accumulated that they need retail buyers to push higher so they can exit. Sometimes it's sponsorship revenue that creates a subtle but powerful bias toward covering projects that spend money on advertising. And you, watching from your phone at 11 at night, have no idea which videos were made because someone genuinely believes in a project and which ones were made because someone got paid to believe in it. This is not cynicism. This is documented reality. The SEC has charged multiple crypto influencers for exactly this kind of undisclosed promotion. The FTC has issued guidelines, and yet it continues. The solution is not to stop consuming crypto content entirely. Information is valuable. The solution is to treat every piece of advice, including this one, with appropriate skepticism. Ask, does this person have a disclosed position in what they're recommending? Ask, what is their track record? Not just their wins, their losses too. Because anyone can claim they called the top of Bitcoin in 2021 or the bottom in 2022. The question is whether you can verify it with timestamps. Ask, are they showing you data or are they showing you emotion? Videos that make you feel excited, that play dramatic music, that use phrases like, "this is going to be the biggest opportunity of your lifetime," are not analysis. They are performance. Good analysis is sometimes boring. Real conviction doesn't need a hype soundtrack. Build your own framework. Use on-chain analytics tools. Read the actual documentation of protocols you're considering. Look at the tokenomics. How many tokens exist? How many are held by insiders? What the unlock schedule looks like. These things are public information. Anyone can access them. But almost nobody does because it takes time and effort. And watching a YouTube video is easier. The market rewards the people who do the work that the crowd is too lazy to do.
So let's bring this all together. Your crypto portfolio is bleeding, and now you know why. You've been buying narratives instead of assets with real fundamentals. You've been trying to time a market that is specifically designed to punish timing. Your diversification strategy is just concentrated risk wearing a different disguise. You've been reacting to price instead of responding to value. You entered positions with a dream of the upside and no plan for the downside. And somewhere along the way, you let the loudest voices in the room make decisions that should have been yours alone. None of this makes you foolish. It makes you human. These are the exact same traps that have caught institutional investors, fund managers, and people who have been in crypto far longer than you have. The difference between the people who lose repeatedly and the people who build real wealth in this space is not intelligence. It is awareness. And right now, you have more awareness than you did 25 minutes ago. This cycle is not over. The infrastructure being built right now, the tokenization of real-world assets, the expansion of Layer 2 networks, the maturation of decentralized finance, the institutional adoption of Bitcoin and Ethereum through regulated financial products, this is the early innings of something that is going to reshape how value moves in the global economy. But you cannot participate in that transformation if your portfolio bleeds you out before it happens. Protect your capital, build your thesis, do the work, manage the downside, stay skeptical of the noise. And if this video gave you something real, a perspective shift, a new question to ask, a reason to look at your portfolio differently, then hit subscribe, because that's the kind of conversation we have here every single week. This is not about getting rich quick. This has never been about getting rich quick. This is about understanding the system clearly enough to make decisions you can stand behind. That's what separates the people who survive multiple cycles from the people who keep starting over. Now go check your portfolio. Not the price, the thesis. See you in the next one.